Hi everyone, it's MJ, the fellow actuary, and in this video I want to discuss different ways to invest in foreign indices. Now, how this came about is I've recently purchased the S&P 500, and I was talking to a friend who's a chartered accountant and also got like a master's in finance, and they too had purchased the S&P 500, but we had both purchased it in two different ways. Now, of course, this is not a recommendation for the S&P 500. Before you invest, go check out my video that I made at the beginning of this year, which tells you to look at, your personal circumstances, your investment goals, your liabilities, and a whole bunch of other things before you make an investment. So because we both bought S&P 500, please don't take it as a recommendation for why you should go and buy it, because S&P 500, it's still quite a volatile asset. But anyway, enough about that. Let's come back to, maybe let me just explain quickly what the S&P 500 is. It is simply the top 505 US companies. So it's a nice way to get a passive exposure to the American market. Now, the reason why I like the passive approach is because I don't have the time or expertise to go and analyze each of these 500 companies. I don't know if Google's going to outperform Apple, if Boeing's going to continue to fall, if McDonald's now there's time to buy or not. I just don't, like I say, have the time or expertise. Remember, in America, especially the American market, it is probably the most efficient of the equity markets, just in the sense that it is the biggest. And you've got analysts who are dedicating their entire lives, or their entire job is analyzing these stocks. So to think that you can do some stock selection as a side hobby, good luck. It's not something that I'm going to do. So that's why I am a passive investor. Of course, being a passive investor is not necessarily that simple. There's still some active decisions you need to make. And what we're going to do is discuss, like this is one of the decisions. Do you do my approach or do you do my friend's approach? And my approach was to go onto the local stock exchange, so the JSE. I then looked at the various exchange traded funds, and there was Satrix, there was Core Shares, but I ended up choosing one called Sygnia. Now, the reason why I chose Sygnia is because it had the lowest total expense ratio. Of course, this is not a recommendation for Sygnia. Before you buy into any of these passive funds, you want to consider, how is the index built? Is it using full replication? Is it using a synthetic approach? You also want to consider, a whole bunch of other things, as well as its tracking error. But for me, I was a little bit lazy, and I was just like, no, what's the lowest total expense ratio? And I then purchased it. So I then give my money to Sygnia. Sygnia then creates a fund that mirrors the exposure of this American top 505 companies. Whereas what my friend did is he took his South African rands, he converted them into dollars, he then sent them to America, and he then purchased through an American trading platform. He bought shares in Vanguard, and you could also do iShare, and I think there's a few other ones out there. And by him doing that, his management fees that he's paying Vanguard are actually a lot lower than what I'm paying Sygnia. But I pointed out to him that he also needs to account for the currency conversion cost. By changing rands into dollars, and then when he brings it back, dollars into rands, there is going to be a fee there that he needs to account for. And Forex exchanges, they're not as simple as it sounds. It's not like buying Bitcoin, you buy at this price, you sell at that price. It is a little bit stranger. So that was the one thing. The other thing which I kind of like about my approach is that I'm using a local custodian. I'm using local rules and regulations that I understand. I understand the tax system here in South Africa. Well, I understand the tax system more in South Africa than in the United States. I don't think anyone can really appreciate a tax system unless, again, you've dedicated and studied and specialized in it. So what my friend's doing is he is exposing himself to a different set of rules and regulations, and that means if something goes wrong, it's going to be a lot harder for him to try and sort it out. Where with me, I'm buying it here, I'm buying it through my local bank. Investec has got a stock platform, so it's quite quickly I can just call them up and say, hey, what's going on? Where with him, the time difference, there's a lot more complications. But like I say, we're both trying to invest passively in a way to minimize our expenses. So it's going to be interesting to see which approach is better. And I'd love to hear your guys' opinions. Which way do you think is better? Is it better to buy locally and then pay slightly higher management fees? Or is it better to go into the foreign markets, pay lower management fees, but then have to deal with other complications? Look, if you're going to go into the foreign approach, you also open the door to a whole bigger investment universe. You can buy the Australian index fund, you can buy the Japanese index fund, and you can buy a whole bunch of other things. Whereby going to your local stock exchange, you are limited to what the companies here are offering. And this Sygnia top 500 companies in America is a fairly recent product. I can't go and buy the Australian index because that isn't available to us on the South African exchange. So that is one of the drawbacks of my approach, is that I am a lot more limited into which ones I can choose. But anyway, I just wanted to give an overview of these two approaches, and like I said, I'd love to hear your thoughts or your approaches to investing in foreign indices in the comment section below. Thanks guys so much for watching, and I'll see you next time for another video. Cheers.